Imagine, for a moment, you're refinancing a loan, and your advisor comes to you and suggests intentionally taking on a higher interest rate. Sounds completely backwards, doesn't it? I mean, it goes against every instinct we have about borrowing money. Yet, in the, let's say, the nuanced world of strategic capital management, sometimes the most unexpected move is precisely the smartest one, especially when you're looking beyond just those surface-level numbers. Today, we're taking a deep dive into a fascinating real-world case study. It involves a Class B multifamily property just outside Dallas, Texas. And we've pulled insights directly from capital markets experts who didn't just watch this happen. They actually orchestrated the solution. So, our mission, to unpack why what seemed like a more expensive loan actually ended up lowering the overall blended cost of capital, unlocking significant value, returning cash to investors, and, critically, giving the sponsors back control of their own destiny. We'll look at the strategic thinking, the detailed execution, and the frankly surprising results. So let's pull back the curtain on how a higher rate could genuinely be a better deal, especially for any executive out there navigating these complex capital decisions.
Yeah, what's truly fascinating here, I think, is how this case study directly challenges our sort of ingrained assumptions about debt and capital structure. It really vividly illustrates that the true cost of capital isn't always what it appears at first glance, you know? And for executives, understanding this difference isn't just some academic exercise. It can be a game changer for those high-stakes strategic decisions.
That's a powerful way to put it. So let's set the scene for you. We're talking about a 228-unit Class B multifamily property located pretty strategically near Dallas. Now, this asset was acquired back in early 2020. The sponsor had a very clear value-add plan. Buy in a high-growth market, put in some moderate capital, and push the rents. Pretty standard stuff. Their all-in basis for this property, including about $3.5 million in CapEx, came out to roughly $35 million.
Right. And their initial financing structure is absolutely key to understanding the dilemma they face later on. They got $21.5 million in senior debt from Freddie Mac. Now, this was a 10-year fixed loan at an incredibly low 2.75%. Plus, it had 5 years of interest-only payments. I mean, at the time, that was a really solid, very competitive structure.
Yeah, 2.75% fixed for 10 years. On its own, that sounds like a dream deal, especially back then. But there was another significant layer in there, wasn't there?
There was. To, round out the capital stack and really juice the projected returns for their limited partners, they brought in an $8 million piece of preferred equity. And this pref equity, it came with a pretty steep 13% IRR hurdle. That's the internal rate of return the pref investors needed to hit before the common equity, like the sponsor, really saw their big payday.
Okay, so that pref helped them reduce their own cash into the deal down to about $5.5 million. But when you put those two pieces together, the cheap senior debt and the expensive pref, what did that do to their overall cost?
Well, that's the thing. Their overall blended cost of capital was sitting closer to 6.9%. Not terrible, but definitely influenced by that high-cost pref layer. So fast forward 5 years, it's April 2025, and their business plan. It had largely worked out just as they'd hoped. They'd done the renovations, tightened up operations, and significantly grew the net operating income, the NOI. The property's value appreciated nicely, too. It hit around $48.5 million. That's about $230,000 a door, supported by a healthy 5.5% cap rate on a trailing NOI of $2.65 million. So, on the surface, everything looked great, a real success.
The performing asset growing value, that's exactly what you want to see. But I'm sensing there was a significant but coming. What was the real pressure point here?
There definitely was a looming challenge. Despite the property performing so well, that original senior loan, the Freddie Mac debt, was set to expire at the end of 2025. This created a very real ticking clock for them. The sponsor found themselves at a crossroads. Basically, the options were sell the asset, refinance the debt, or try to restructure the capital stack somehow. Now, selling wasn't ideal. These guys were genuinely long-term holders, believed in the property's future upside. But restructuring that 13% preferred equity, that was proving incredibly difficult, maybe even impossible on good terms. And that's what really led them to explore refinancing options, but with a bit of a twist.
This is exactly the kind of situation, isn't it, where an executive needs to think like several moves ahead, beyond just the immediate fire drill.
Absolutely. It forces you to look past the simple metrics and really consider the whole chessboard, so to speak.
Which brings us right to the core question that makes this deep dive so interesting. Why on earth would anyone, especially a smart executive, want to refinance into a more expensive loan? It just seems completely illogical on the face of it.
It does seem illogical, which is exactly why we need to stop playing checkers here and really start playing chess with the capital stack. See, the real drag in their situation wasn't that low-cost Freddie Mac senior debt, even though that 2.75% rate was amazing. The true burden, the piece that was really eating into their potential profits and, crucially, their flexibility, was that 13% compounding preferred equity. It was sitting ahead of the sponsor in the capital waterfall, the order people get paid out.
Not the waterfall, right.
And that 13% wasn't just a static hurdle. It was a compounding obligation, growing bigger every day.
So the strategic thinking wasn't about finding the absolute cheapest new money available. It was about strategically replacing most expensive, most burdensome piece of the existing structure.
Precisely. That's the core logic. Swapping that really expensive 13% compounding piece for a new loan at 6.75%, even though 6.75 is higher than 2.75, was a win because the new lender had a fixed return and, importantly, no equity kicker, no claim on the future upside. It fundamentally changed the math for the sponsor's blended cost and their potential return.
Okay, that reframing makes a huge difference. So what were the key benefits they got from doing this?
Well, several critical things. First, and this is always good for investor relations, it allowed them to return some capital to their limited partners. That's a win. Second, and this is huge for the sponsor, it triggered their promote eligibility. That's their disproportionate share of the profits once certain return hurdles are cleared. So it accelerates their participation in the deal's success.
Right, gets them closer to their bigger payday.
Exactly. And third, it gave the sponsor back immense control over their timing. It removed that huge pressure to sell the asset, maybe prematurely, just to pay off that compounding equity.
And I think I remember reading in the source material about the new loan having flexibility too, like prepay options.
Yes, that's a crucial detail. The new bridge loan was structured with prepay flexibility. So if market conditions improve significantly, maybe rates fall in a year or two, they have the option to refinance again or sell opportunistically without facing huge penalties.
That kind of optionality feels incredibly valuable, especially in today's market. It's almost like buying insurance for future flexibility.
It really is. And if we connect this back to the bigger picture for any executive listening, it's all about understanding the true cost and the strategic implications of your entire capital stack, not just focusing narrowly on the nominal rate of one loan. It really makes you ask the question, what's truly driving your returns? Or maybe more importantly, what's hindering your flexibility and control? Sometimes it's that piece of capital that looks cheap on paper but has hidden costs or constraints.
That's a really profound point, and it underlines that this whole thing wasn't just, finding a lender. It was this incredible strategic ballet analysis, negotiation, communication, all designed to make the entire capital stack work better for them. So how did they actually pull this off behind the scenes? What were the practical steps involved?
Yeah, it was definitely a multifaceted approach, much more than just a simple refi transaction. The very first step was doing some serious valuation modeling. They built multiple models, looking at different NOI scenarios, different cap rate assumptions, somewhere between 5.25% and 6%, which was realistic for that Dallas submarket. The goal here was basically to prove, both to themselves and their LPs, that there was substantial real equity value in the deal that could actually be unlocked through this refi. They called it proving refinance feasibility.
Okay, so a lot of analytical groundwork just to build a case and show the value was really there. What came next in terms of the financial engineering part?
Next, they ran pretty extensive interest rate sensitivity models. They used forward rate curves to figure out if refinancing now was the right call or if waiting might make more sense. And the analysis was pretty clear. Holding on to that preferred equity any longer would just make its final payout bigger because of that compounding effect. It would keep eating away at the sponsor's slice of the pie. So waiting, even if it meant maybe getting a slightly better rate on the new debt down the line, would have actually cost them more in real dollars on the pref side and delayed hitting their promote. Understanding the speed of that compounding was just as critical as looking at static interest rates.
That's a great insight, thinking about the cost of inaction. So, okay, they knew the value was there. They knew the timing was right. How did they actually go about securing this new higher rate financing?
Well, third, they really leveraged their broker and lender network. They ran a highly competitive process to get lenders interested. They managed to source over 5 different term sheets, which gave them real leverage to negotiate the terms thoroughly. Ultimately, they decided on a bridge loan structure. Now, bridge loans are typically shorter term, maybe a bit higher rate, but they offer flexibility. This one gave them interest-only payments and, crucially, no onerous owner's covenants, those restrictions lenders sometimes put on borrowers.
So it wasn't just about the rate, even the new higher rate. It was also about the terms of that loan, getting that flexibility and freedom baked in. What other pieces needed to fall into place, it sounds like, more than just the loan itself?
Oh, absolutely. They also did a really meticulous review of the joint venture waterfall agreement, which we mentioned earlier. They needed to pinpoint exactly when those promote triggers would hit under the new structure. That was essential for the sponsor to understand their own economics going forward.
Makes sense. And I imagine dealing with investors in a situation like this could be tricky, right?
Yeah.
Especially when you're pitching a move that seems counterintuitive on the surface. How did they handle that communication?
Yeah, investor communication was absolutely paramount. They worked closely with the sponsor to frame this refinancing in investor updates, not just as a rate decision, but as a strategic reset. They clearly explained the logic, getting rid of the expensive pref, accelerating promote, gaining control. This ensured the limited partners understood the why behind it, maintained that trust, and got everyone aligned.
Keeping those LPs fully informed and understanding this strategic reset must have been vital for maintaining trust. Okay, and one last piece. What about the legal side? These things can get complicated legally.
For sure. Finally, they worked really closely hand in hand with the legal team. That coordination was critical to make sure the preferred equity payout fully complied with all the original agreements. And just as importantly, they needed to structure it carefully to avoid any unnecessary tax headaches or capital allocation problems that can pop up in these complex deals. So the takeaway there is it's not just about getting the loan done. It's about thinking through the entire capital strategy end to end, covering all the angles, legal, financial, investor relations.
Okay, so after all that strategic maneuvering, the modeling, the rate analysis, the competitive bidding, the waterfall deep dive, the careful communication, what were the actual results? What did the new deal look like on paper?
All right, so the new bridge deal came in at 65% loan to value based on that new $48.5 million valuation. That generated $31.5 million in fresh loan proceeds. It's a 3-year interest-only structure, as we said, at 6.75%. And yes, let's acknowledge it again, that is significantly higher than the original 2.75% senior debt rate.
Right.
But as we've established, you can't just compare those two rates in isolation because the original stack had that incredibly expensive 13% pref layer weighing it down.
Got it. So how were those $31.5 million in new proceeds actually used? Where did the money go?
It was allocated very precisely. First, pay off the old $21.5 million senior loan. Second, pay off the entire preferred equity balance, including its accrued return. Third, cover all the closing costs associated with the refi. And after doing all that, there was still about $1.2 million in cash left over, which was returned directly to the sponsor and their investors.
So a direct return of capital. Even if it wasn't a huge windfall, that must have been a pretty strong signal to the LPs, right?
Absolutely. It was meaningful. It demonstrated progress. It successfully hit the LP's required IRR hurdle from the original structure. And maybe most importantly for the sponsor, it triggered their promote eligibility. That was a huge milestone achieved.
Okay, now let's really get into the economics, the before versus after comparison, because this is where that counterintuitive aspect really comes into focus. Can you walk us through the numbers on the payments?
Definitely. So before the refinance, remember, the property was making annual payments of about $806,000 on the senior debt, plus another $1.4 million just to service the preferred equity's 13% return.
Okay.
So all in, that was nearly $1.85 million per year in total capital costs hitting the property's cash flow.
$1.85 million a year. And after the refinance?
After the refinance, with the new single loan at 6.75% interest only, the annual payments are $2.13 million.
Right. So the actual cash leaving the property each year to service debt increased by, what, nearly $300,000. For many people, especially executives focused on cash flow, that's the point where this whole strategy seems to break down. Can you really unpack why that nominal increase is actually a strategic win?
That is the absolute core insight, and it's vital to grasp. While the nominal cash cost, the annual payment, did go up, the blended cost of capital for the entire structure actually came down significantly. Why? Because that incredibly expensive and compounding 13% preferred equity was completely eliminated from the stack. That was the anchor. More importantly, maybe the whole capital stack was dramatically simplified. There's no more compounding IRR obligation hanging over their heads, no more tension around forcing an exit to meet that pref deadline, and crucially, liquidity was returned to investors, and the sponsor regained complete control over the asset's future. The annual free cash flow went from roughly $800,000 before the refi down to about $520,000 after. But, and this is key, this was a conscious strategic trade-off. The sponsor and investors understood this and accepted it in exchange for that increased upside potential from hitting the promote sooner, the newfound clarity in the capital structure, and that critical flexibility and control over the asset's timing.
So they traded some immediate cash flow for long-term strategic advantage.
Exactly. And this case really highlights the core lesson for any executive managing capital. Success isn't always about chasing the absolute lowest interest rate on one particular loan. It's truly about optimizing your entire capital stack for your strategic goals. Things like control, accelerating your own promote or upside, and maintaining strong alignment with your investors.
This whole deep dive really hammers home that message, doesn't it? It's about thinking beyond the obvious numbers, about playing, as you said, financial chess, not checkers. And it shows that even in a rising rate environment like we've seen, there are still really smart, creative ways to reposition deals if you look at the whole picture.
Absolutely. Replacing truly high-cost capital, even if it means taking on slightly higher rate debt, returning preferred equity, accelerating your promote, regaining control of your timing, sometimes these strategic elements can matter just as much, if not more, than the specific interest rate on one piece of the debt puzzle. And honestly, this is where the real advisory value comes in for executives digging into these complex structures, solving for those tricky promote triggers, helping sponsors unlock value without necessarily needing a full asset sale. It's about, cultivating those financial wins from very specific strategic moves.
So what does this all mean for you listening, whether you're managing a large portfolio or leading a company's financial strategy? It really means thinking beyond the obvious metrics. It means understanding the interconnectedness of all your financial decisions and always asking yourself, what's the true blended cost of my capital here? And what strategic flexibility am I really gaining or losing with this particular decision? So take a look at your own capital structures. Are you maybe playing checkers, just focusing on individual interest rates? Or are you playing chess, strategically positioning all the pieces for long-term value creation and control, even if it sometimes means making a move that seems, well, counterintuitive at first glance?
Exactly. Remember, true financial acumen often lies in understanding that nuanced interplay of all your capital components, not just getting stuck on the surface level numbers that might, frankly, deceive you.
That's our deep dive today into unlocking value by strategically and perhaps surprisingly choosing a higher rate loan. We really hope this has given you some powerful new insights for your own capital management thinking.